Good afternoon to everyone who's joined us today. I'm going to give just a couple more minutes and let some other attendees pop in here since it is the lunch hour. I'm sure everybody's, or at least the lunch hour on Eastern time. For those on the West Coast, maybe it's breakfast. But allow folks to get settled with coffee or lunch, and then we'll dive right in. Okay, well, we'll go ahead and get started. I'm sure folks will trickle in as we go along. We also intend to record today's session and have the recording and the slides available to those who either join late or need to drop earlier, one way or the other. We do have all participants muted just because there's a good number of us. please feel free to use the chat function. If you have any questions or comments or feedback as we go through, feel free to type it in there. And then at the end of the session, we will get to questions. And that's actually my favorite part of the presentation is when we get into discussion. So look forward to that. So we'll dive in. So we're all here today to talk about M&A, my favorite topic, but in particular to talk about what is happening in the greater M&A market today. There's a lot of opportunity. The market is wildly hot right now, as I'm sure we're all hearing from various sources. And so what does all that mean? So that's what we're here to talk about today. What we intend to cover, so these are kind of the key objectives of today's session, things that we hope you walk away from, strategy around how good deals are executed, the market trends, valuation trends, deal trends, and terms and due diligence, and what all that means in terms of what's going on in the greater landscape of the M&A market. So I'll introduce myself. My name is Dina Jalbert, for those I haven't had the opportunity to meet before. I am the founder and CEO of Align. I have spent my career in M&A, came out of school and did transaction advisory for Ernst & Young and have been doing it ever since. So I'm a quintessential deal junkie. I started Align just about 5 years ago, focused on the lower middle market because I really saw a need there in the low to mid market for M&A support. As fragmented as the industries are, there just weren't enough service providers. So that's where our team has come in. I've been fortunate enough over my career to have facilitated quite a bit of M&A transactions across a wide variety of industries. So everything from venture tech to HVAC and everything in the middle. Our firm, by definition, we are generalists. We facilitated transactions in pretty much every vertical. I've had the opportunity to close deals with organizations, such as Google and Bank of America, Hewlett Packard, among others. And so I like to think I've got the history here to hopefully be able to point out to you all why the market today is so strong, unlike anything I've seen in my 20+ years of running deals. So let's jump into that. So why is that? Why is that? Why is the market so strong right now? Well, the lower middle market in particular, or mid-market, those are businesses with revenue anywhere from 5 to 10 million to 100 or 200 million. So the businesses that I like to coin as too big to be small and too small to be enterprise. These market conditions have been, for the last decade or so, very strong. There's been a lot of capital invested there. And it starts from a lot of businesses in this demographic are owner-operated or family businesses or in some form or fashion. And so there's a succession change that's happening with those who are in the baby boomer generation, if you will, are kind of reaching the end of their careers and thinking about what that next chapter looks like. And there may not be family lineage there. There may not be family succession there. That populace was the first to send all of their children to higher education. And so by virtue of that, they don't have, they're not working in mom and dad's or in the family business as often per se, or at least don't want to necessarily own and run it themselves in the future. So there's a pivot point that's coming from a timing perspective. We're also seeing a lot of investment from financial investors, which we're going to talk a little bit more about who those are later, but those are your private equity groups, your family offices, debt lenders, different type of financial sponsors, as we call them, who are investing heavily in this demographic of business. And why are they investing? Well, they're deploying growth capital. As you'll see here in the bottom right, we talk about growth capital, giving money to these high growth businesses to take them beyond where they are today. And so they really help them get to that next stage. So if you're a $50 million a year in revenue business today, how can you get to be a $500 million business in the future? And they're really adept at providing that capital for growth. They also use that capital for consolidation and for acquisition. So you'll see here, and kind of one of the yellow boxes there, the lower middle market by definition is fragmented. So there's hundreds of thousands of these businesses across the country, and they tend to be regionalized in their market share. Not all, but tend to be regionalized in their market share. So it's a great target for consolidation. You can buy 10 or 12 smaller businesses, pull them together, and get to that $500 million a year in revenue business. By virtue of this demand, there's strong valuations being paid. Valuations for enterprises have, for the lower middle market, have been on the rise, but are even more so in demand today than they have been historically. So because of the competition that you're seeing between financial sponsors and corporate acquirers, they all have a lot of money to spend, and they're all competing for good assets. So it's the age-old supply and demand. The less there's a supply, the more demand. Valuations tick up because people are willing to pay up for good assets. And most importantly, especially as we sit here all today, the lower middle market businesses, for the most part, as kind of shown through COVID, is they are less impacted by larger macroeconomic events. So we saw the lower middle market be a bit more insulated from COVID. The COVID effect, or the recession that we've heard of over the last year. Now, putting aside your hospitality companies and your travel, which was kind of truly its own exception to that rule, but for the most part, the lower middle market had some effect, but not materially. Most of our clients that we're seeing have bounced back even more so, and are often growing, and really any impact was nominal. And that's what investors and acquirers look for. They look for that steady, recession resistant. I mean, nothing's ever recession proof, but recession resistant business. And then corporate organizations, your publicly traded companies, your large privately held companies, they're sitting on piles of cash too. And there's more cash on corporate balance sheets than there ever has been. And the fastest way to growth is through acquisition. It's the age-old, buy it versus build it yourself. Organic growth can take time, and the fastest way to get either to get market share, whether that's through a new product, service, geography, what have you, is to acquire it. So you've got your financial sponsors, and you're consolidating, and then you've got your corporate organizations acquiring and consolidating, driving up those valuations, allowing for the succession planning of businesses to happen, and the ability to consolidate throughout fragmented industries. So all of those conditions are at play right now, and really driving a really strong M&A market. So let's talk about 2020, because as much as all of us would like to forget about the last year and a half, what's interesting to see is that, in 2020, domestic M&A deal values dipped below $2 trillion for the first time since 2015. That said, over 12,000 deals were still completed for a total of $1.7 trillion. There was a period where COVID brought deal making pretty much to a halt, and that was really in the March and April, that Q2 timeframe last year. But what we saw is that as federal intervention took place, and we all kind of learned to live with the, I hate to use the term because it's overused, but the new normal, the third and fourth quarters, things opened back up again, and the pace picked up. So while it was down, not substantially down as compared to when you look at coming out of the 08-09 recession in 2010, how much more impacted that was then, and we'll get to the why around that here shortly. As I mentioned at the outset, there were some sectors that were impacted more than others. Energy, hospitality, the B2C market, some retail, especially smaller retail versus e-commerce. They were all, they had far more of an impact than other industries, but healthcare, technology, financial services, business services, so the B2B buckets there, they all still did pretty well in 2020. Deals were still strong. Where we saw some pinch was in materials and resources, the supply chain issues that I know many of you are all dealing with, that came to bear in terms of M&A in 2020. But overall, the year rebounded pretty substantially and has given great tailwinds into 2021. What I think is most important, though, is that while overall the deal volume may have gone down a smidge, what you'll see is that in the mid and low market, the deals that were done were dominated in those categories. The volume was concentrated there. You'll see here that the bar chart in 2020 for companies that are, deals that were under 100 million, actually inched up a little bit. And similarly, those from 100 to 250 were almost flat, maybe slightly down. Where you saw those really take a hit were here at the top, right? Those 5 billion and up, 1 to 5 billion, the larger enterprise deals, because the macroeconomic conditions hit them more. And you see the same here when you look at, there's dollar volume on the left chart, and then dollar size on the right, and you'll see that the smaller deals, all those bars are all larger than they were in the prior year. So they actually were resilient, and that continues to be the case. A lot of that was driven by the financial investors doing quite a bit of add-on acquisitions, and we'll get to what that means here in a little bit. So 2021, why is it so hot? Why is everybody calling me? I'm sure your phones have been ringing off the hook. You've been getting lots of letters and emails, telling you how strong the market is. Well, why? Why is that the case? And so, as I mentioned, the greater economy had an impact with COVID, but we all seem to be kind of coming out of that again. And they're not changing their M&A strategies. And why is that? Is because there's cash. Cash is everywhere. There's $2.5 trillion of private equity money that has been undeployed. And what that means is these financial funds have gone and raised $2.5 trillion from endowment funds and pension funds and high net worth investors and other investment groups. And they have all that money and it's sitting on deposit and it needs to be used. The only way that money makes a return for those people who are investing in them is that money gets spent. And there's a time horizon. I don't know about any of us who invested money in anything, we want it to generate a return. And if it's not being used, it's not generating a return. So we have $2.5 trillion of money that is sitting and undeployed that needs to find a home. Similarly, there's $2.4 trillion of cash on corporate balance sheets. So on deposit in banks, on the balance sheet, corporations have all this money to invest. So that means two things. They're going to invest in organic growth. So all of us who are suppliers to those organizations or vendors or partners, that's going to help fuel growth. And or they're going to turn around and use a good chunk of that money for acquisitions. A good example is, I'm sure many of you saw last week, Zoom acquired Five9, which shows that they're taking the cash that they have and putting into some growth areas. There are many organizations doing. They've seen a lot of consolidation in the food delivery space. Uber Eats has been buying up Postmates and some of the others. So that consolidation within corporations is continuing because they have so much cash on hand. Both of those organizations have cash on hand, but at the same time, debt is the cheapest it's ever been in some time. The U.S. federal funds interest rate is near zero. Money is never completely free, but it's as close to free as it can get right now. Both corporations and financial sponsors use debt, use leverage as a part of their transaction. So that's another pool of money that they can utilize. It also means for growing businesses, access to leverage to grow your business organically is also there as well. And then, the kind of last phenomenon we've seen over the last couple of years or 18 months is this huge prevalence of specialty purpose acquisition companies, or SPACs. There's a tremendous amount of money that has been raised through those acquisition companies. And what a SPAC is, for those on the call that may or may not know, is it's a shell company that goes public, and shareholders buy in and they raise money, and then that money is then used to go and do acquisitions of private companies to essentially take them public. It's something that Canadian markets have done for some time. Hasn't been as prevalent a tool used in the U.S. Until the last year, but there's been almost a 500% growth of proceeds raised from SPACs, and that money has a time horizon as well. It has a 5 to 7 year timeline, I believe, until it has to be returned back to shareholders if it's not deployed. So, all of this means there's just a ton of cash out there, and it has to find a home. All that money doesn't generate a return unless it's invested. So they're interested in buying lower to mid-market companies, doing that consolidation, bringing them either into their corporations or creating larger corporations via consolidation, and having that cash generate a return. Because of all that money, EBITDA multiples are on the rise. They continue to rise. Traditionally, and you'll see it even in this chart here when you look at 2010, even 2010 through 2013, historically, transaction multiples, they go down with the economy. If the economy is in a recession, then valuations tend to go down. That's because the pool of money used for those acquisitions shrinks as well. So back to that supply and demand, there's less demand because there's not as much capital. But in today's market, as we just were discussing, the ability to buy is stronger than it ever has been in past downturns, and that's what makes it so unique, and why it's so white hot for lack of a better term. It's the abundance and the mix of capital that's available. So because of that, people are still buying. Valuations are going up because there's competition for assets. So the more competition there is and the more cash at work, it continues to drive up rates. And we're seeing them, honestly, I'm seeing valuations at the highest I've ever seen in my 20-year career. I mean, we closed a transaction in December that was almost 13 times earnings, and in a normalized scenario, I guess, 8 times. You can't see me, but using my air quotes there, in normal, it's defined differently by many. But so it traded significantly above value, and we're seeing that with many. And we're also seeing terms much more seller friendly too, which we'll get to that and why that matters in a bit. So, it's really important, I think, this data point in terms of why the M&A market is the best it's ever been in decades, and why this growth period is so unique as compared to others. It's the abundance of cash, and why folks should really strongly consider looking at an exit for these reasons. You've got all-time high valuations, cash that's going out in a record pace. And once that cash is deployed, then it's deployed. So, there's a time horizon, that is relatively shorter term, where that money has to find a home. So it's creating some urgency for folks, as it should. Again, just kind of highlighting different views on EBITDA multiples, but 2020, even though it was a down year, the multiples were still exceeding prior year rates by almost 30%. And as I mentioned earlier, despite COVID, deals less than 50 million are on the rise. So volume is high. Another catalyst and why the M&A market right now is the best it's ever been is there's also a time pressure. Everybody's favorite topic, capital gains tax. So taxation is changing drastically in 2022. So right now, capital gains rates are at 20%. And this chart, really shows you kind of the ebb and flow of capital gains rates over the years. This is slightly outdated in that it only dates back to 2015. But right now, rates are are at about 20 to 21%. That said, President Biden has proposed to nearly double the capital gains rate and make it retroactive. So, closing a transaction in December of 2021, you would reach that 20% rate. You close January 2nd of 2022, you're going to be looking at, almost 43%, 40 to 43% in the total rate. So a matter of 30 days can make a pretty drastic difference. That's twice as much of your proceeds that you would get out of a transaction that you have to remit in tax. Now, many low, mid-market, and mid-market businesses are pass-through entities. So you're an LLC or an S Corp or an organization other than a C Corp. So there are nuances to that, but kind of worst case is the capital gains rate will double, which means twice as much goes to the government if you were to exit your business. And one of the things that we're asked often is, well, that's okay. If valuations are on the rise, then the value, if I were to exit in the future, valuations are going up, so I'll still be in the same place. That's actually not the case, because yes, while valuations are strong right now, they are not growing at a clip that would make up for the extra proceeds that would be needed to kind of get you where you would be if you exited today, tomorrow. And so I find this chart really impactful, because what it illustrates is that a business owner needs to grow his or her business by more than 45% over a 12-month period to overcome the doubling of the capital gains rate, and assuming only a 5% reinvestment rate of proceeds. So that's challenging to do in a singular year. And even if you take that 45% and say, well, I'll do it over 5 years. The challenge that also happens is that not because you are pass-through entities, most are pass-through entities, the personal income tax rates are also being increased. So the income that you receive every year, they're taking a bigger chunk of, and they're also going to be increasing the corporate tax rate. So for those that are C Corps, the tax rate will be going up. So all in all, the amount of cash that is retained by owners and or businesses is going down, and just makes it that much more challenging to get to the same place as to where you are today. We hear from folks often like, well, I don't want to sell today. I want to hold on to it for 5 years, and I could probably get an extra $5 million. Well, when you walk that extra $5 million back over a 5-year period between what you have to pay in additional individual income tax or corporate tax, plus the capital gains, you're pretty much kind of where you are today. But you've had to put in 5 years worth of effort to grow your business a significant amount to kind of get to where you are today. So that's why we're seeing a large rush of folks looking to facilitate a transaction by year end to take advantage of this. And facilitating a transaction by year end doesn't mean that you have to roll out, unless you want to. That's personal choice. But a lot of companies think that, well, if I rush and do a transaction, then that means like at the end of the year, I'm out of a job and I wouldn't know what to do with myself. For most of us, our identities are tied up in our business because it's a child. It's something we've grown over so many years, and you might not be ready to let that go. You don't have to. That's the beauty of it, is there's ways to structure these things so that you can take chips off the table today, take advantage of all these valuation opportunities and the strength of the market, avoid the future tax implications, but also get future upside for the period that you decide to stay on, whether that's 12 months, 24 months, 10 years, whatever that horizon may be. It's all in how you structure it. So to that end, there are the two main types of acquirers, and I talked a bit about this in the earlier slides that talked about market conditions. Private equity, or a financial sponsor, as I refer to, because there are many flavors of private equity, but private equity broadly is, and they are an investment fund. So, investors buy equity in an entity. It's not publicly listed or traded. They raise that money, as I mentioned, from high net worth individuals, firms, pension funds, endowments, college, all those things. And then they use those funds to purchase shares of private companies. They all have different strategies. They all have different ways they go about doing that. Some are full buyout shops where they want 100% and they own the business. Others only want maybe a minority stake and get that growth capital. There's many different ways to do it. I always say private equity is kind of like Baskin Robbins. There's 31 flavors. And it really, they're a good partner because they have that breadth and flexibility across the different types. And the key there is to decide which of those would best fit your long-term strategy and figuring that out. And then you have your strategic acquirers. And this is the bucket where most folks believe M&A takes place. Like, oh, I just sell to my competitor and then I'm going to go and play golf permanently. And while that's absolutely an option, if that's what you want it to be, that's fantastic. It doesn't have to be. A strategic acquirer is a corporation, whether public or private, a larger business, or perhaps a peer that is looking to grow and they want to bring in new products, services, markets, et cetera, into their organization. So versus building it themselves, they'd rather just go and buy it and more quickly have that presence. It brings speed. To go into a new market usually takes anywhere from 1 to 3 years to start to get a real hold there. Whereas if you bought an existing organization there, you kind of have instant presence. But what's in it for me though? I sell to a strategic. Well, you'll get paid well for your transaction, but it gives your business the opportunity to grow beyond where they are today, and it gives your people opportunity to grow beyond where it is today. So both have their pros and cons to them, and it's really about just determining what your individual need and strategy is and how those fit. We talked about consolidation earlier. The low to mid market is extremely fragmented. There's over 350,000 companies in the US alone. So that's why investors and acquirers are so voracious for this demographic of business. And again, why your phone and email has been blowing up is they're chasing that because there's so much opportunity. Even if you get a small percentage of share, there's still a lot of market available. So it generates a lot of great returns. And those who have strong recurring revenue, strong customers, good regional presence and brand, they're highly sought after prospects. And as we mentioned last year, PE firms invested in new growth strategies or new platform investments, if you will. It represented almost 25%, like almost a quarter of all deals. The other 75% were add-on acquisitions for those platforms. And so what I mean by that, they call it a buy and build strategy. Strategics do this similarly, but this is the method that PE elects the most. And what they do is they'll buy one organization in an industry. And that is what they'll call their platform. And to kind of compare it to a house, it's the foundation. So they're buying the foundation and the land. And then that platform serves as the base. And then they're going to go out and buy 10, 20, however many more organizations and build on top of that. So then you think about all the floors and the walls and everything that gets built on top of the foundation. The idea being you build this big house or you build a bigger company, and then you turn around and sell that big house or bigger company to someone else, whether that's a strategic or it's traditionally another larger financial investor. So it's a really good opportunity for those who want to be along that journey, and we'll talk about what that looks like monetarily and why later. But consolidation is a key component of that strategy, and again is another reason why you're likely receiving lots of phone calls. So what's in it for me? Why should I be thinking about this now? Like, yeah, okay, valuations are strong, cash is there, but yeah, life is good. I don't need to do anything, and that's great. And so way to look at it is to think about, your motivation in good times, good economic times versus slower times. In a down market, if things are slower, a lot of sellers will look at it because they need to, satisfy some cash requirements. They don't want to have to deal with another downturn. It's not fun anymore. It's not the best time to sell though, right? It's when it's not fun and things aren't going well, you're not going to achieve as much value as you could and should. And those are those trigger events that we like to call. You're kind of waiting for something to happen to trigger you to to go through an exit versus really paying attention to timing and looking at motivation in a buoyant market. So here we are. We're in one right now. It's one of the best ever. And so, why should I be thinking about this? Perhaps you're approaching retirement. It doesn't mean that it's retirement today or tomorrow. It could be 5 years or 7 years from now. We work with many clients who they're like, I'm looking to retire in about 10 years, but I want to start now. I want to start planning what that looks like, take some chips off the table today. There's a way to structure that. So looking at that succession, the business has grown to a point where it's just bigger than you want to handle with your own two hands. It could grow beyond where it is that you frankly don't want to. And if you were going to, you need, some support and help with that. The capital required to take a business from, 50 to 75 million in revenue and doubling it, it's much harder and it's much different. And there's also a personal risk, in doing that. You could go out and take a bunch of debt leverage and grow all that yourself. But with that, unfortunately, comes a lot of personal guarantees and risks. So it also, in times like today, you can find a partner who will fund all that growth. I always say you're spending somebody else's money, and you don't have to take on that financial risk. If anything, you're sitting on a pile of proceeds that you just took out of getting a first set of proceeds. And you can check that financial security box. And in good times or when exit opportunities are abundant and valuations are really strong. If you wait for a down market, it's not that opportunities won't be there. There just won't be as many. It's certainly not as you won't have as much optionality. So, well, that's great, Dina, and I hear that good versus bad. We all want to sell when the getting's good, but I just don't know if I'm ready, and that's fair. Especially when you're hearing a lot of pull around taxes are changing and things are really hot right now. It's really important for you to take a personal inventory of what it is you would want to do and what you might consider. As we mentioned, acquirers and investors come in many different flavors. So it's a function of really finding that right party to deliver what you want and what you need. So what do you personally want? Do you have a lot of runway left, or are you looking to kind of hang it up soon? There's no right or wrong answer there. Is there a specific number that you would need to fund whatever that next chapter of your life looks like, whether that's in the shorter term or the longer term? Have you talked to a wealth manager to figure out what that needs to be? What do you want for your people? People are a company's most valuable asset. And what do you want, what type of opportunity do you want to provide for them in the long term? And what are the growth opportunities for the business? What you've been able to build yourself with these businesses, but gosh, if someone dropped a pile of money in your lap and let you go invest in all the things that as a smaller business owner, it's more challenging to do. Like, gosh, what could you do? Where could you grow? What are the opportunities there? That's what acquirers are investing in. And if you see that there's a lot of runway there, well, then that's something that's really valuable to folks. So it's something to look at. And every person is going to have different answers to all of these questions. Businesses are like people. Every single one is different than the other. So there's no one right answer. But it's a personal decision point and something to think through. And it's not something you want to be reactionary about. I know that there are many investment groups calling and acquirers calling companies directly. And that's the market telling you that there's demand for your business, which is great, but you are reacting to something that someone else is putting forward versus being proactive and strategic and kind of thinking through these questions of what you want and then saying, okay, well, here's what I want. Now, how do I go get that? And are the people that are knocking on my door offering that to me? Most of the time, they're not. Their hope is to try to get it off market, hope to kind of get it at a discount for being the first to get to you. And that's where being proactive and working with the team and going out will allow you to answer those questions and get the results from those. The second bite of the apple. So I was talking earlier about private equity and how they consolidate. and they build the bigger house, right? Put all the floors on, do all the acquisitions, build a bigger house. Well, then they're going to sell that larger company or the larger house to someone else, whether that's another company. Oftentimes it's another financial buyer. Those are the buyout, big buyout shops you hear in the media. So some of those larger financial sponsor groups. And so how does this work? Like, what does that mean? So the private equity firm will buy your company in full today. But then as an owner or a leader in the business, you have the opportunity to reinvest some of the proceeds you get from that transaction back into this now larger entity. So you become an owner of this larger entity. So everyone, by virtue of that, is an owner and is excited and growing this larger business. So you grow the business substantially, both organically, but then through additional acquisitions. As I mentioned, you're building the other floors of the house. So then you turn around and sell it. Because you're an owner of this larger entity, you get to participate in that transaction as well. And that's what's known as a second bite. So you take a first bite in your first transaction with the PE group, and then you get a second bite down the road, usually in about 5 years, although we're seeing that shorten due to the voraciousness of the market right now. But on average, it's about 5 years. So you get to participate in that transaction as well. There's usually, not always, but most of the time in the deals that we've done over the years, there's a pool that's set aside for employees too, which is a really exciting opportunity. We've seen that happen. As an example, we had a client who was a platform company. Business had been around for 45 years. The owner was exiting, and they had a controller on staff. She'd been there 35 years. She was like one of their first employees. But she was ready to retire. And the owner said to her, if you could just stick on and help us get through this transaction, get the new people acclimated. And then after that, she's like, oh, absolutely, no problem. Well, she was granted some equity out of that equity pool that they gave to some employees. Even though she was retiring, the owner just wanted to really reward her for 35 years of service. So she was granted some equity. Well, that platform just exited this past December, and it sold for $1 billion. She got a phone call to say, on Friday, you're going to be getting a wire for $12.5 million. So that was a nice Christmas present for her. And that's not exaggerative. That's very commonplace. The goal of these groups and the reason why that equity pool is meaningful is it incentivizes people to grow the business and get as much as you can in that second transaction. Oftentimes, we see owners roll about 30%. On average. Now, it could be more, it can be less. And we've seen some where they've only rolled 2%. We've seen some where they've rolled 49%. It's entirely a personal preference. But just for example's sake, say you retain 30% ownership. You grow this big company and it exits for $200 million. Say you grow up to $20 million EBITDA and it sells for 10 times that, so $200 million. That means as a 30% owner of that business, you would reap an additional $60 million in that second bite. And that's on top of what you earn in your initial sale, the first bite. So it's extremely lucrative. Now, there's a risk and reward trade-off, of course. It's the age-old two in the hand, metaphor. But I've seen this work time and time again. It's very powerful. And so that's where, folks who think that M&A means I just have to sell to my competitor and I'm out in the street, that's not the case. You could be a part of something like this and stay on for 5 to 7 and help get through that second bite, and then maybe then is when you're ready to roll out, or not. I mean, I know many CEOs who've gone on to work with the next set of financial sponsors and get a third bite. It all is specific to the person, but it's a real opportunity and one that's often not known a lot about and thought of. So we always like to present that because right now in today's M&A market with valuations so strong, these second bites of the apple are extremely meaningful. As I mentioned, we just had a number of clients who are part of that platform who just sold in December, and they all did significantly better in the second bite than they did on their first, and they did very well in the first as well. And so we've seen it work many times, and we always like to make sure that folks are aware that it's an option. So valuation. I've been talking quite a bit about what valuation is. I always cringe to talk specific about valuation because, as I mentioned, businesses are like people, and they're all unique. And that's why you'll see on this slide here, average deal multiples have been anywhere from 3 to 10x for lower middle market businesses. I'll tell you what, though, those, and this, I probably should have updated this a bit before we presented it today. I'd say it's even higher. I'd say it's sliding more in that 5 to 12x range. It's definitely split up. We haven't seen any deals for below 5x recently. Now, that's just a range. That's an average, right? It's the age-old standard deviation. We've seen them much higher, and it all depends on the size of the company, how consistent and predictable your revenue is, how strong your margins are, how well you manage expenses, how much of your how many personal expenses do you run through the business? Nobody judges that. It's a common, I have in 20 plus years not seen a case where that hasn't happened. I mean, there's always personal expenses there, but how much, how much are you running through there? So I mentioned EBITDA earlier without defining it. For those who may not know, EBITDA means earnings before interest, taxes, depreciation, and amortization. So what that is it's your net income adjusted for interest, taxes, depreciation, and amortization. And that's the number that starts the valuation calculation. A lot of clients will ask us, well, we feel we should be traded on multiples of revenue. Okay, that's fair, but at the end of the day, people pay for cash flow. Now, there are some extenuating circumstances in tech or where there's a lot of intellectual property and some things that profitability may or may not be the main driver there, but for 98% of lower middle market M&A transactions, it all starts with EBITDA. Because EBITDA, the reason for that is it shows what the assets of your business are able to generate. It shows what your brand, what your people, what your widget, whether that's a service or a product, who your vendors, like how you've done it. It's the results of the operation. It's not just an arbitrary number that doesn't mean anything. It illustrates to a buyer what this asset can perform at, and how it can be improved over time too. Another key point that's often overlooked is your team. How strong is your team? Do you have a right-hand person or team of people that support you, or does everything live and die by your two hands? Do you have a strong team in place? If you do, that's more valuable. If you don't, not necessarily deal breaker, but it can devalue the opportunity. Market share. How saturated are you in your market, or is there room for growth? Whether that's growth locally or more broadly. Brand recognition. How strong is your brand? If you're a service, what kind of reviews do you have? What's the word on the street about you? If it's positive, that's valuable. If it's meh, because we know most of the time people like to leave a review only when things are bad. It can. So there's a lot of, and this is a very short list. There's many other things to consider there, and that's why it's hard to pinpoint valuation. Every time we have these webinars, the questions that we get are always, my business does X amount in revenue. What am I worth? It's like, well, it's hard to say because every business is different and it can swing widely one way or the other. But we're seeing extremely strong valuations right now. It's definitely a seller's market. Valuation, though, is the what, but the terms and the conditions are the how. There's more to a deal than how much you get out of it. It's how the deal is structured, and the terms that you're given are equally and oftentimes, if not more, important. A lot of our clients rarely go with the top bidder because usually the top bidder comes with a lot of contingencies and a lot of strings attached. It's the age-old, like, yeah, I'll pay you $500 million for your business, but I'm only going to pay you $5 million for it today, and the other $495 million will get paid out over time upon achievement of metrics that are ridiculously high. But then, buyer two comes and says, well, you know what? I'll pay you $50 million 100% today. It's the age-old two in the hand, but and that's a small example, but there's a lot more to a deal than just the dollars and cents. And the terms and conditions really harken back to the what do I want questions. if offer requires you to stay on for 5 years and you're like, I've got 12 months tops, that's not probably the right buyer for you. Or vice versa. I want to stay on and have a meaningful role, and the new buyer's like, nope, we want to replace you with one of our people. Again, that's not, you want an equity pool for your people, they won't give one. All of those things. And then there's a lot of key components that business owners don't realize, and they come to roost at this point in time. So there's indemnification and liability. You have to make up a lot of promises to a buyer. You're telling them, like, I believe what I'm telling you is X, Y, and Z. And it's written out in a legal agreement, and they're called representations and warranties. So you'll see that number 5. A representation and warranty is essentially you're making a promise and you're guaranteeing that things are what you say that they are. If later down the road they find that what you said is the case is not, that's where the liability and indemnification comes in. You're on the hook for any claims or issues that come from there. And there's a lot of nuances around how much and when and timelines, and there's quite a bit of detail there that can make it really painful. And so the terms are, again, I can't stress it enough, are equally as important as how much. And then there's non-competition, non-compete. You'll have an employment agreement, and I mean, this is only the number that could fit on the page. There's so many more there that you have to consider, and it's just, we point all these things out only in that you have to ensure that they line up with your deal strategy. In today's strong market, though, what we are seeing is that terms and conditions are the most seller-friendly we have ever seen. We are seeing very few earnouts. We see almost always 100% cash at close. Now, in some industries, like construction, for example, those tend to have some earnouts in them because it's contingent on long-term projects and things actually coming to fruition. So there are some exceptions to that, but we're seeing the baskets for indemnification liability being very low, shorter non-competes, more limited non-competes geographically, and all sorts of things. They're far more flexible now than they ever have been because they want to get deals done, and they're willing to put a little more risk out there to get a good asset into the portfolio or into the company and generating assets. So yes, values are strong, but even more importantly, the terms and conditions are far more flexible. And they won't always be that, because the first place they start to pull and firm up is in the terms and conditions. All that said, it's a lot for an owner to take on a process like this themselves. Finding a buyer and receiving an offer is really just one step of the process. And getting a deal closed is another. So because the market is so strong right now, there are folks rushing to want to get deals done, which is great, as they should. But you also have to be prepared. It's not a process it's not like just listing your house. There's a lot of preparation that has to happen. You have to have your financials in order, be able to get to the right legal documents, have all your HR records in place, understand your insurance, and all sorts of things. And it takes a lot of people to help you weed through all those things. It is, if there's ever one piece of advice that we could get in order to take advantage of today's strong market, is to have a team of people to help you. Have a good M&A advisor, have a good M&A attorney, not just an attorney, but an M&A attorney, someone who has done deals in the past and is well versed and can prove that out. A good CPA, one who understands bookkeeping and taxation, because the two go hand in hand. And the reason by having all that is they can help you navigate all of the stuff. They can help you get through a process much faster and make sure that you aren't leaving money on the table, inadvertently signing up for some risk that you didn't mean to. Make sure that you're thinking through all the tax ramifications, and making sure there's no open tax liabilities and issues. So it takes a team, but if you've got those people, the process can move quickly. So for example, if you're thinking about doing something today, you get that team in place, you could get a deal done by the end of the year with no question. But without this preparation and understanding what's coming, it's going to be more challenging. So to conclude, timing is everything. It's the best market we've seen. It's crazy strong. I actually had a call with 2 private equity groups yesterday that said that they can barely keep up with the amount of deal activity that's in front of them. I talked to a couple of peers at some larger investment banks who actually have stopped taking on new business because they're just so overwhelmed. You know, the market is white hot right now. A lot of it driven by the tax changes that are coming, but also, you know, the strength in valuations and the amount of capital out there. So, you know, the market is strong. Terms are totally flexible. You know, being proactive allows you to design the outcome you want versus reacting to what somebody's offering you. And another piece that folks often don't think of is, you know, your competitors are receiving funding from strategic acquirers and or financial investors. So that means within your local market, you don't have to compete with really deep pockets because they now have a partner who can, you know, they call them and say, hey, I need X, Y, or Z, and they write a check and, you know, they've got it immediately. Whereas those of us who are smaller businesses, it's challenging to do that. We don't have that, those deep pockets, and it can be, especially with service-based businesses in particular, that can be a real challenge. So something to think about. You know, this white hot deal market means, you know, your peers are looking at these opportunities too. So it's something to certainly think about as you look at your overall long-term strategic plan. But you know, there's trillions and trillions of dollars out there looking for a home, and so hopefully this helps you understand why folks are calling on you at the rate that they are, and gives you some tips and some ideas as to how to take advantage of what's happening in the marketplace today, and you know, hopefully be successful with that. So that's enough of me talking. We've got a few minutes left here. Any questions? I haven't seen anything in the chat. Does anyone have any questions that we can answer? No? Awfully quiet. Okay, well, fair enough. What we can do is we'll follow up with all of you. You know, I'll reach out and provide my contact information. Oh, wait, I see someone typing. I shouldn't be so quick to say that. Oh, great. Thank you, Kathy. That's very nice of you to say. But we will follow up with all of you. We'll provide you with these slides for reference. And if you have any questions, want to bounce anything off myself or any of our team members, you know, please don't hesitate to reach out. We have team members all throughout the country who are well-versed and able to chat with you. You know, we love just an informal conversation, just to chat and bounce ideas off of. So please don't hesitate to reach out to us, and we'd be happy to schedule those sessions. And have a great rest of your summer. I appreciate your time today, everyone, and have a great day.